One byproduct of the Great Recession, persistently low interest rates. And now Federal Reserve Chairman Ben Bernanke says you can expect those to linger through late 2014.
So unfortunately for savers, there's really no light at the end of the tunnel.
What is good news for borrowers turns out to be grim news for savers. People seeking safety in the form of fixed income investments like CDs are stuck in a return on investment rut.
I have a checking and a savings account at one bank, and I can afford what I'm doing now, although it's getting harder and harder.
It's the not so often talked about downside of the Federal Reserve's extraordinary efforts to knock the economy out of its slump. The Fed chief acknowledged that savers essentially have to sacrifice during times of economic hardship for a greater cause.
The savers in our economy are dependent on a healthy economy in order to get adequate returns. In particular, people own stocks and corporate bonds and other securities as well as, say, Treasury securities. And if our economy is in really bad shape, then they're not going to get good returns on those investments.
So with the outlook for low rates extended, so is the expectation of miserly returns for savers.
Well, Mother, she's always concerned about having enough money to last her the rest of her life. And her investments, which are a money market account and some CDs, really, it's a concern for her.
McBride says one should investigate a variety of investment alternatives to avoid the low-rate curse.
You don't want to move out of cash investments whole hog, but what you do want to do is sprinkle in some things that give you the opportunity to earn returns that preserve the buying power of your money. Things like investment-grade bonds, dividend-paying stocks, even things like real estate investment trusts or inflation-linked bonds.
So after the Great Recession, a financial hangover for which there's no easy cure. Mark Hamrick, The Associated Press.